All right. Well, thanks so much, Mark, for joining me for this video. Just to kick things off, why don't you tell the listeners or watchers who you are, a little bit about your background and your relationship with Reins?
Sure. Well, I'm certainly glad to be associated with Reins as outside legal counsel and relating to my expertise or my years of practice, which is over 40 at this point, doing executive compensation focused on incentive plans, stock plans, phantom stock plans. Um, I've worked with small and large companies, public and private, throughout my career. And for over 20 years of my career, I was working in a law firm that had 1,000 lawyers, and I headed up the executive compensation practice. Probably the last thing I'd mention was I also spent over 10 years teaching at Georgetown Law School on the subject of executive pay, securities issues, tax. We covered accounting. So my background is generally, compatible with what Reins is doing, and glad to support the effort.
So you're a little qualified to speak on the subject.
I feel comfortable with what we talked about.
Great. So why don't we start off with this? What is phantom stock and how does it work?
And it's quite something to see the title there because over the years it gives you the sense that it's something that's elusive or mysterious, but it's actually really straightforward. The phantom component really means it's an award that's paid in cash rather than stock. So we can have a phantom restricted stock award, which we also just call phantom stock. Essentially, it gives an individual who receives the award the financial upside of stock without any of the ownership attributes. So there's no voting rights. There's, that's the main thing that's given up. No rights of a stockholder to review company records. So for a closed company or a private company, most owners tend to like phantom stock because they can use it as a great financial incentive without expanding their shareholder base or giving up their control of the company.
Got it. Do you have to share information with phantom stockholders?
Yeah, it's a good question. Technically, you really don't. You have to have a mechanism for valuation, and the more credible that mechanism is, the better the plan works. In a plan itself, you would never be setting it up so that you're required to give information. Usually, a phantom stock plan has some type of, it's usually an annual value where you tell people, here's your award or your awards, and here's how we valued it most recently. That's normally a very good communication device. But to go into the weeds of how it was valued, you never really want to do that because you don't want to be second guessed. We set up plans to actually be as ironclad as we can be to avoid questions about valuation by saying essentially any good faith valuation by the company is going to be withheld. We don't want to litigate value. In theory, if we ever got dragged into court, which is absolutely the last thing that we're wanting to do, and we're trying everything to avoid that in the way we document. But you would have to, in some respects, if there was a valuation case, you'd have to start looking at how you defended value. So, from my perspective, the best thing a company does is when they do the annual valuation, be consistent, have some internal record of how it was done, so that if anyone ever looks at it and says, how did you decide this value? The company can say, oh, here's how we did it. This was consistent with past years. We're being honest and straightforward. But in general, you're not required to share that, and I would not suggest anyone share it unless they had to.
Great. Now, do phantom stockholders, employees, individuals that are receiving phantom stock, do they have to purchase it and or do they have the right to exercise it at any time?
Yeah, two good questions there. The first one about purchase, the answer is actually no, because phantom stock is really just a promise to pay money in the future from a company's general assets. So you can't really purchase a promise. That's
Hmm.
different than restricted stock. If I had a restricted stock plan where I was able to make someone, an award that said, Chris, today you're going to become the owner of these shares, but you have to earn them over the years. That would be restricted stock. And in those cases, if I use restricted stock, that is an item of property that you can sell to the person. 95%, even higher, of plans do not involve anyone buying the award. Usually it's an award that's given out, and it's the simplest way to do it. You get into securities issues, and they're sophisticated when you start selling stuff to people because you have to make sure that they had full disclosure of what am I buying into. So the best type, the simplest and more straightforward award, no purchase price. Now, going to your second question, um, there are two kinds of awards that can be made. The typical phantom stock award is called a whole value award. So that if you give me that award, I have a right to a share of stock or the value of a share of stock at a point in time. And if that value at a point in time is $100 a share, I get $100. If the company's gone down 10% to 90, I get $90. But I have a whole right there. Very different is an appreciation only award. We would call that either a phantom stock option or a phantom SAR, where SAR stands for stock appreciation right. That can often be a desirable award because sometimes a company, say with a new employee or a new line of business, whatever it might be, they may feel that we don't want to give away past value. We only want to give out an award to this person if they make the company, soar in value from the date of the award going forward. So in awards like that, if there's no appreciation, if the company stays stagnant in value, it has no value. On the other hand, if it goes up in value, there's a payout attached to it. So it's a more sophisticated award to put together. I would say, Chris, you didn't ask me this, but hopefully it'll be something that's good to know, which is a phantom stock option, or SAR phantom, has one big downside, I should say, which is if a company doesn't go up in value, it has no value to the award.
Mm.
And as a result, in public markets as well as private companies, much more often you see the whole value awards. So there's some value absent appreciation, but what you really want, obviously, is an award where the stock goes up in price, the person stays employed, and gets an incentive that's drawn from the increase in price over time.
And just one quick clarification. So in either scenario, the phantom SAR or the phantom option, you could either have it exercisable or similar to the whole value, which is it's you don't have an exercise, it's triggered by some future event. Is that correct?
Yeah, you ask a really good question. It really is part of the design process and
Right.
kind of a sophisticated part of it,
Yeah.
because Code Section 409A, which is the bane of existence for tax lawyers, because it's complicated and it essentially imposes a 20% tax on individuals if a award is violating 409A. There's a special award for stock options or SARs, which means that first, the exercise price has to be determined by market at the time of the grant. And second, there needs to be an exercise price and an exercise date. You can have the award be designed to be an automatic exercise, such as, Chris, at the end of 5 years, whatever your appreciated value is will be paid out in 5 years. Or we can have it be something that you have the right to control. But we have to make sure that if we do that type of an award where you pick the exercise date, we have a good record of why the exercise price or the base price for measuring appreciation is defensible as fair market
Got
value.
it. So more scrutinized when you bring in the
Exactly.
exercising right.
Yep, exactly.
Okay.
And by the way, in that context, most private companies are under the 409A rules protected through a safe harbor, which means get an independent valuation and comply with the 409A rules that give you protection if you're going to do a phantom stock option or SAR.
What are the benefits of phantom stock for companies or owners of small businesses?
Sure. Yeah. Most small businesses do a great job, I would say, or a good job with annual bonuses. They usually figure out what works for their company. They also tend to fill the gap on retirement in a way that works for them. It might be a simple 401k. It might be a profit sharing approach into a tax qualified plan. But they have retirement covered at the long term side and the short term bonus. Phantom stocks kind of fills that midterm gap where you want to have someone have an incentive to stay either for several years or until an event like a change of control. So phantom stock, when it's thought through well, is going to look at what the company is trying to achieve through retention, and it's going to try to come up with a mechanism that fills that gap. So it's on the one hand a stake in the future to give the person a reason to have the company be profitable, and also a reason to stay employed on a longer term basis.
Are there any downsides for the company to do a phantom stock arrangement?
Yeah, that's a really good question. I guess the only downside I could see, because the company is really in charge of designing the plan, putting on the table essentially what they want to put on the table. Um, if they did have a downside, it would just, I guess it would be just in the sense of life itself, which is you've made it more complicated. You've added a plan, you need to administer it. Um, you can't, don't screw it up. Have someone that knows what they're doing advising about the plan, doing the record keeping for the plan. But other than that, a phantom stock, if it's modeled right, is going to be basically be a predictable device. And at the front end, when the company puts it in, if they say, we want to give 20% of the value on the change of control to our employees, just throw out something out there, and then all of a sudden they sell for $50 million and now 10 million goes to employees, they need to know at the front end that's a fair number. And often the skill of it is to model the plan at the front end to figure out what happens on a change of control. What happens if 3 people leave in 1 year and 4 more leave the next year and we have no workforce in the following year? Figure out how the plan is going to impact company operations. Those and I don't know if they're downsides, but they involve thinking it through.
What are the benefits for phantom stock to the employees or the individuals who are receiving these types of awards?
Yeah, I think one thing to start with is phantom stock is a form of ordinary income. It's really just like a deferred bonus. So, in almost all phantom stock cases, you don't get an annual payout. But what you do is you have something that kind of in a way tops up the annual bonus. So, if I had an annual bonus of 10% of pay, I might have phantom stock accumulate for another 10%, but only get paid out on a change of control, termination of employment. I like to pay out, I think a suggestion I have for a company that's concerned about someone leaving for a competitor would be something that would say you only get paid out a year after you leave, but you have to honor your non-compete or trade secret obligations. So we can put it together in a way that for the individual gives them a significant upside in terms of if I stay employed, I'm going to have an accumulating benefit. I'm going to have a stake in the company, and I'm going to collect it as long as I'm not what I would call a bad leaver. I think that's the fair balance, is to say, I used to give talks on executive compensation where I would say, it's really hard to get 2 companies or 2 executives to agree on exactly the right form of compensation. But everyone agrees that, if you've worked for a company and you're a good leaver, you should leave with good benefits. And I think that's what phantom stock can do.
How do you think delivering a benefit like phantom stock to an employee of a small local business differs from the benefit that maybe an executive in a larger company um, would have?
Yeah, a couple things come to mind. One is, there is, I think in smaller businesses, you have more of a trust element with your workers where, there's more of a personal connection than a bigger company. And that translates into the plan in a couple ways. One is, I think you want to be careful about giving out the awards. And a lot of companies with Phantom Stock will start with 1 or 2 key people, get comfortable with the award, make sure it's working, and then be thoughtful to expand it. In a bigger company, they might just give them out to 100 people right away. And I think I do go back to the trust element too, because when it comes to valuation in a private company, that's, public companies are easy. You look at the stock market, you figure out the value. Private companies need to have a mechanism that they trust and that their employees trust for making sure that they do have a fair value. And, what you never would want to have is a plan that backfires by people feeling like they're being deceived, misled. You want the plan to come across as being straightforward, above board, and a solid incentive.
So this is a really popular question that we get all the time. How do I know how much phantom stock to give?
Good luck. No, that is the eternal
Yeah.
question. Um, I guess, um, one thing that I encourage private companies to do is to look at public company compensation for similarly sized companies, from revenue to size of workforce. And you can kind of look at what they do and kind of get a sense of, because they're your competitors for talent in many cases. So if you look at a average public company, 10 to 20% of the company is often reflected in stock awards. So I think for a phantom stock plan, I would start, I might start with a 10% award, but I think I would be thoughtful about, do you necessarily want to give it all out right away? In public companies, a 10% plan usually covers 3 to 5 years or 2 to 4 years, something like that. So I think that private companies can draw from that. Now they're also much more flexible. If I'm a small company and I'm the founder and I'm looking for some critically important key person to bring in, probably 5% might not do it. So you can cut, and I think that leads to what's really key is it has to be individualized and assessed on that scale. Again, by thinking through at the front end, what am I willing to give? How am I going to structure it? Because if Chris, if I was hiring you to run my company, you might be worth 30%, and I might be glad to pay it, but I might say, Chris, you got to work for me for 5, 6, 8 years to get that 30%.
Yeah.
I see stumbles a lot of times where the deal is so, in a small company, is vague, and it'll be the person works for a couple of years and says, wait a minute, I was promised 10% of the company. And then all of a sudden they leave, and there's not really a clear record of, did the person get their 10%? Was it clear they would lose it if they left? All those things, which is why we have to have, in my experience, a good plan and a good award agreement to avoid all those risks of misunderstandings.
And that's one of the benefits of a tool like Reins, is really to formalize the administration of a benefit like this. We hear that all the time from small business owners, where they they have a back the napkin type of agreement and no one really understands. There's no formalization of the actual benefit, and then that just, it actually does the opposite of what you're intending to do when you're giving out something like this.
Yeah, and having seen how you've set up the website and the ability of a company to design their plan, I think the way you put together the drop-down menus and the choices, it makes it straightforward. And so I feel like a small business can look at it and make, a good informed decision at the front end about the design. So then they can look at the overall product and say, yes, we put it together in the way we want.
Yeah. Yeah. And the employees have a place to go and see, oh, here's what this is. Here's what this means. It's a legitimate benefit. It's an actual thing that I can understand, wrap my
For
hands
sure.
around. We talked about this previously, but how do you value phantom stock, and in what cases is it required? In what cases is it not required?
Sure. I think anytime you're giving out phantom stock, and we can have different meanings for phantom stock too, because we could have a company where we're giving out awards based on total company value. We can have awards that are based on value in the line of the business. So we'll define at the when we make an award, how we want it to work. Um, if it's a whole value award, we can pretty much put in place of any valuation mechanism that we think is fair and reasonable. You know, and we could, for example, even the IRS code would say multiple of book value. Could be you could have a multiple of revenues of EBITDA, whatever it is. A company can establish a formula um, when they, and I think that can be fine for a whole value award. If we move into an appreciation only award, a phantom option or a phantom SAR, now we go back to what we started with, the 409A concern, where we really do need some type of evaluation by an outside party, because that's what, under the IRS rules, gets you a safe harbor from a tax nightmare, frankly.
And from, just to clarify, so the valuation on the whole value award is really for the benefit of everyone to understand its value, but legally it's going to be valued at the future triggering event, should it be anchored on a change in control type of arrangement, right? And I understand there's arrangements where that isn't the case. You're paying it out for some other trigger, but in that scenario, is it legally required to have a valuation upfront?
No, no. The key thing is never to mislead employees or give them bad
Mm-hmm.
information. So, like,
Mm-hmm.
take an example. If I had a plan that only paid out in change of control, because I that was the only time I felt like I wanted to give away a big piece of the company to my
Mm-hmm.
um, if a company just went out and said, "Good news, Chris, your award's worth $1 million," without necessarily having any basis in change of control value, you would be able to say to them in hindsight, "Wait a minute, I was misled over this value." That's what a company never wants to do. So they've always got to be communicating a reasonable number, and like I said, I would have internal records not given out, but to just show how did we do the calculation. But it's not legally required to have any, like, I don't have to do evaluation of the whole company, or if I did awards based on a certain division, I wouldn't have to have an independent valuation of that, as long as I've written it properly to give it to have that depend on company discretion. And then in that case, if there was an argument, it's all reasonableness. You want to have a reasonably defensible approach.
How does phantom stock differ from structures like profits, interest units, stock appreciation rights, ESOPs, actual equity in a company?
Yeah, you've hit on some very different um, incentives, actually. An ESOP is short for Employee Stock Ownership Plan. That's like a 401k plan that's stock based. Um, so in that case, you actually are put either buying shares of stock or issuing them to a retirement plan. And then and that's a plan that has to be open to all the employees of the company by law, or all eligible. And, those are the retirement plan rules. By contrast, a phantom stock plan can be selective. You can have one person in it for one award. You can have two people with completely different awards. So, as we mentioned, your drop down menu of choices, we could have one arrangement for employee A and a completely different one for employee B, depending on what we want. The key when companies differentiate is just they can't discriminate based on, like, Title VII, age, gender, race, religion. But as long as they keep it clean in that respect, there's no requirement that everyone participate, that many people do, or that everyone get the same thing. So they're very flexible in that way. You mentioned profits interest. That's a fascinating topic. And that's probably, if you think of the scale of complexity that we could put in front of companies, that's the most complicated incentive of them all. On the plus side, I always talk about profits interest as the holy grail of executive compensation, in the sense that it's possible for a person to get capital gain treatment for their income rather than ordinary income. And that can save a lot of tax dollars. But there's a huge cost, because it is a very sophisticated device that requires a lot of ongoing support, valuation, accounting, tax advice, and it's generally an incentive. And to, so basically, like, to take a simple example on profits interest, at the end of each year you figure out, what's the appreciation in value, that's the profit. The person figures out their award, they're taxable on it arguably, and then we have to do what's called a book up and figure out, okay, now this person has a tax liability, how are we going to handle that down the road, until we cash out. So it's complicated, and generally something that, in my experience, like, 1 out of 20 companies wants to go down that road. Phantom stock, by contrast, is so much simpler, because you can just define what's going to be the value that you want, whole value or appreciation only, and you can figure out when it pays out. And at the payout date, we have a tax date. So it's straightforward in that way, where profits interest, along every single year that there's a profits interest, there's going to be a complex accounting and tax accounting required.
So I realize it's probably nuanced, and you would want to consult on an individual basis with companies, but generally speaking, if you can, is there ever a scenario where a small, let's say like owner operator type of business, sub 50 employees, would want to choose one of those more complicated equity type instruments over a phantom stock to retain or incentivize key employees?
Yeah, it's a great question. My immediate reaction is anytime a company's putting a plan together, they should at least have some conversation about the alternatives, just as we're having now. But having said that, 95% of the time, they're going to go with what we're talking about. And I would say the two most common choices are going to be a phantom plan, phantom option, or phantom stock, or a stock plan, restricted stock or stock options. Those are going to suit the highest percentage of companies possible. Profits interest, ESOPs, they're out there, but they just are so much more, in my experience, sophisticated and time consuming and expensive that most small businesses would rather do something straightforward.
Is restricted stock or stock options available or accessible to the breadth of small privately held businesses in the US who are structured such like an LLC or an S corp type of structure?
Yeah, yeah. I mean, they're certainly possible. They just involve, an added layer of ongoing administration and compliance because we've gone from the simple phantom stock or phantom stock option plan, which is just track an award and track the cash payable, into something that now has stock rights. And are we going to have buyback rights? Are we going to have rights of repurchase if someone gets them? Does the person vote them? How are we going to work out? So there's so many attributes of stock that then have to be worked out for that type of a plan. And it's not to say that it's not suitable, but it is, more complicated.
Generally, what is the taxation treatment on phantom stock?
There's a good straightforward one. It's ordinary income at the time of payout. Now, one thing that's possible with phantom stock, suppose I had a plan that said, Chris, if you work for 3 years, your phantom stock vests and you get the money, even if you're employed. We could have a plan like that, pays out at the 3 year point. When we start the plan, I could give you a choice, a deferred compensation election. And I could say, Chris, when you get the award, you have a choice. Do you want it at 3 years, or would you rather delay the payout date till some future date? Could be termination of employment, change of control, a fixed date in the future. The nice thing with phantom stock is we can allow deferred compensation elections like that. It adds a little more compliance and administrative tracking because now you've gone from paying out on a fixed date to having different people possibly paid out at different times. But going to your question, that's a way that the individual can figure out when they're going to be taxed because it's not going to be when vesting occurs, it's going to be when they collect money. So the simple part with phantom stock, ordinary income when it's paid out, tax deduction for the company when it's paid out, and the two numbers are the same.
So that's interesting. So the deferred compensation election, how does that benefit the employee or employer?
Yeah, it really doesn't benefit the employer because if you defer the payout date, you defer the time of the tax deduction. On the other hand, the company does keep the money, so it's not a loss for the company, but they have to administer it. It is a benefit to the employee who is trying to, you know, say spread income into future years. It's especially good for the person who's retiring because I might go from a very high tax bracket to a low tax bracket. And also, deferred comp elections can allow payouts over time if a company wants to do that through their plan. So we could say instead of getting a lump sum in year three, 10 years from now, you'll start a stream of payments over 5, 10 years. And that way you've spread income over a longer period. A plan can also give the person, an upside of stock interest during that period. So there's a lot of choices become available through deferred compensation. Most of them are things that favor the individual and the executive. So often companies will open that door because they see that as something the executives want, and then they design it in a way that kind of is like a low cost but highly valued benefit.
Got it. But generally, ordinary income when it's paid,
Exactly, that's the rule. Yep,
and nothing is owed when it's vested.
that's right. That's right. As long as it's not paid out, then. Yep.
Yeah, great. Does phantom stock entitle employees to dividends?
Yeah, good question. Um, Depends on the award. So it's really a design choice. Now, interestingly, I'd say most small businesses don't pay dividends. So it's usually not a big issue. But it is a design choice. Most companies would give dividend rights with phantom stock, I would say.
And how does that work? Is it typically baked into the phantom stock plan? Is it a separate short-term cash bonus plan? Could it be both or either?
Yeah, good question. Yeah, it could be. It could be done in any of those ways. I try to keep things simple. I like to have one plan and have everything under that umbrella. And it's on the same thing with like one award agreement. Just excuse me, but just keep it simple in that way.
How does the dividend typically work? Is it discretionary in nature, where if the owner takes a distribution, so does the phantom stockholder, or how do you see it typically structured?
Yes, yeah, I think you're right. You would look at what are the payouts to the owners, and if they took out 10% of company assets, in theory, that's a 10% dividend, and then you would just credit an additional 10%. So if I had 100,000 of phantom stock, I'd now have 110,000 if it went up 10%.
What happens if an employee that has phantom stock or holds a phantom stock award quits or is fired?
Yeah, well, I have to refer you in those cases to the Reins drop-down menus because it really is the design choice of the company. A company can, especially with change of control plans, a lot of companies just feel like, hey, I only want to benefit people who are here until the change of control. Make that choice. You have to be employed on the change of control date. Other companies will say, wait a minute, we want to do it a different way. We want you to vest 20% a year for 5 years or some arrangement like that. But it's completely a design choice. Um, Other choices involve, is death or disability a special event? You've been smart. You've set up the choice system to allow for all those. And it's really just a matter of what does the small business consider best. I think what's important on that question is what you've done in your design features part, which is make sure people know what the choices are so they can make an informed decision and get a feel for the range of choices available so they get the right one.
Now, if you're an owner that's more generous and wants to pay out when folks leave, not just on, require employment on a change of control, does that start to look like retirement type bonuses?
Yeah, great question. Yes, you're probably leading it. You have in your mind ERISA and the Top Hat plan rules, which basically say that if a plan pays out primarily at termination of employment, you can get subject to a lot of complicated retirement plan rules. So in general, if a company is thinking that's how the plan will work, we don't want to allow more than 10 to 20% of the workforce to participate. Because now you're starting to look more like a retirement plan than a midterm retention plan.
Have you seen companies structure awards based on performance milestones, and how does that differ from the standard phantom stock type of arrangement?
The way you described it is right on target because the simplest way to do a plan of this type for a small business is just to determine vesting, which is, when do you earn the award over time? And usually it's just based on continued employment. And that often will accomplish the company goals. Um, a more, one more layer of complexity can be really good when we want to tie an award to performance. And that's where you have a double, almost like a double vesting condition. You have to be working and the company has to achieve a performance goal. And it's a great way to signal what's important to the company. Are we trying to expand revenues? Are we trying to extend, be more profitable? Are we trying to make mergers and acquisitions? Performance goals can be a wide range of company objectives. And I think that what happens when companies go down this road is just like we're talking, it becomes more complicated to figure out what's going to be our added layer of condition for someone to earn the benefit. So for a small business, they have to be almost have an appetite to be more complicated. The simplest thing is just to pick a plan and say vesting is years of service. You're 20% vested if you work a year. Easy, no one can argue about it. Now all of a sudden you say you have to work a year and we have to meet our profits goal. And then it's like, when do we set our profits goal? Is it the beginning of the year? What if we have something happen in the year? Can we change the goal? So all of a sudden, it becomes a more complicated award. But for a company that has discrete objectives that they want to put in front of executives for achievement, that can be a really nice way to put a plan together. And fortunately, you're set up to allow that if someone wanted it.
How can a small business owner use phantom stock in the context of succession planning or taking a step back from the business?
Yeah. Well, I really like the question because succession is an art to itself for a small business. You're taking a place with value that's built up over time. You want to have the right person succeed. I think that I would see phantom stock being step one of the succession process, where you figure out, okay, I'm willing to share the financial upside of this company with somebody else, but I don't want them to yet be an owner. So to me, it's like putting your foot in the water, seeing if it works, and then giving that person the incentive to stay. Ultimately, the owner will want to basically give away the stock or sell the company through like an ESOP or some other device. But I feel like the phantom stock enables the small business owner to do two things. One, introduce a key person to the idea of being an owner and having an owner's financial interest. And then also, staying around and seeing if it works and if it proves the right incentive for the right person.
What's the number one thing small business owners should be thinking about as it relates to phantom stock, but don't, or they don't think to ask?
Oh, yeah, that's an interesting question. I, I don't know if I'm answering your question directly, which I'm going to try to do it. But the first thing that comes to my mind is I feel like, in my experience, 40 years of law working with businesses, the mistake I see often is underappreciating the key employees and underappreciating how important it is to retain and motivate those people. So when it comes to phantom stock, I look at it taking a step back to be the best thing the small business owner can do is say who is critical to this company and then getting out in front of it, not only to create financial incentives to retain the person, but I also like to connect them up with, like non-competes, non-disclosures, trade secret protections. The Federal Trade Commission has got some rules out there right now. They're creating a little uncertainty, but in general, you don't want to have somebody get paid well and then take your customers to the next company. So I feel like phantom stock is part of that equation that's going to be let's have the glue to stick and then also make it hurt a little bit if somebody leaves.
So that's so great. Such great advice. A quick sort of follow up on that is you're talking about a business owner being proactive rather than reactive, right? How do you encourage business owners who are super busy and have a ton of other priorities to prioritize that over something else?
Yeah, yeah, you're right. That is a problem. I've had a lot of companies have to get burned first. I can't tell you how many clients I've had over the years that come to me for a plan after they got burned by a key
Right.
person they trusted. I think that your approach is really the right one from the company side because you just want to make it as simple as possible for the small business owner, have them get started and actually realize, gee, this can be a great retention incentive. And it really isn't that hard to do. I feel like, and going to what you're angling toward, I think, in your thought, and I think you're right that so often it's perceived as something that's super complicated. It's
Mm.
presented as something that's got a million choices and is going to take months of time. And it shouldn't be that way. It should be something that gets started in an efficient fashion. And that's why I suggest start with one or two people, just get the framework so you're comfortable that you can look at it and say, yeah, we didn't give the house away, but we got something in front of a key person. One other thing that I always suggest is you don't necessarily have to promise everything on day one. First, get the mechanism in place, and then you can give an award in year two, year three, year four. So the person might get 2% the first year, then they're 5%, then they're 10% if that's what they want. But it doesn't have to be something where you put everything on the table up front. I like to have a small business owner get started, get comfortable that they trust the platform, and then build from there. And I think that if they do it in that way, in a simple, straightforward way, I think it can work really well.
That's incredible. And now that there are tools out there that demystify this and lower the barrier to entry for small business owners, they can get started without a huge time and cost investment.
100% right. Yeah, that is the best route.
Great. Well, thanks so much for the time and knowledge today, Mark.
All right. Good to be here, Chris.